you.
One of the things I do want to ask you is, before we even get a little bit positive about these numbers and get excited, I just wanted to ask you about the sustainability. One of the things you were saying is that this number, very important, and also if we look at vehicle sales, that's also a very good indicator of where the economy is at. But what we have seen is pullbacks. We see the spike and then we see a pullback, and you were saying that trend could also be something that we could expect in the housing industry. When we talk about sustainability of these numbers, where do you think we're at right now?
Well, yes, firstly, 6.6% is a further acceleration in the house price growth in February on this revised 6.1% for January. And I think what is happening, there's been a recent quite nice period in the economy. You just saw the PMI figures a little earlier, spiking up again. So the last few months has been relatively good. If one looks at vehicle retail, the value of vehicle retail, according to Stats SA, year-on-year growth also showed something of a spike. That's more of a leading indicator. So that spike was in around about September. Our estate agent survey showed something of an uptick year-on-year growth in demand around about the third quarter survey as well, around about that time. Both leading indicators, and I think, and then we saw better economic growth figures in the fourth quarter, and I think that better growth is being reflected in slightly better price growth numbers in the housing market. How sustainable is it? Well, I'm still rather cautious when it comes to the global economy. I think the risks are high, oil prices are high, so there's a lot of indicators which suggest that we may have a slower economic growth year this year compared to last year as a whole. I subscribe to that. The UN, the IMF, a lot of them have said it already. That means slower average growth for the year in terms of our economy, even though we've had a little recent bump. And therefore, yes, I think we'll still stick largely to lower single-digit figures despite this recent uptick.
I want to talk a little bit about that caution, because I was speaking to an estate agent earlier on this morning, and she was saying it's been a dramatic change in terms of inquiries. So people are calling to look at these properties. Well, when it comes to actually signing that offer to purchase, they're not seeing much of that happening. Do you think that South Africans are still a little bit on the cautious side when it comes to making that commitment?
I think they are, but as time goes by, people generally look in the rearview mirror, and that's not only the buyers, it's often the lenders as well of money. Perceptions of risk are determined by recent events, and so the longer interest rates stay at low levels, one would expect to find that a gradual increase in confidence levels, because our perceptions of risk are largely determined by recent events. I don't subscribe to, I don't believe it's the correct way to assess risk, but I think for a lot of people that is the way it is assessed. So I expect to see this year, against a possibly slower economy, which we expect, something that could cushion that blow, although it doesn't look like a blow at this stage, but against a slower economy, I think slightly more relaxed lending and confident borrowing as the year goes by might just support prices a little. As that so-called recency bias sets in, when we look in the rearview mirror for a few years now, we've seen a relatively good period, and the recession is fading in the memories.
We also have seen those interest rates coming down, and that could also feed into that recency bias that you're talking about. Do you think that is going to impact on people going forward? Also, considering that going into the year, there is a lot of comment that we could see interest rates probably go on the uptick going forward.
Well, I'm not convinced that interest rate cutting is all too. I don't think it's quite that clear cut that further interest rate reduction at some later stage is out of the question. Depending on how the rand behaves itself, and of course we are moving towards in the next few months to a higher base of which global commodity prices grow. So the year-on-year growth rates in global commodity prices have been declining, notably oil. The base effects will come into play. The producer price index has started to slightly taper off in terms of its year-on-year growth, and so we could be peaking soon in CPI inflation and moving back into the target range. But even if we were to get further interest rate cutting at some stage next year, or whenever if it were to happen, I don't think it would be significant moves. And yes, we are broadly speaking, I think at or near the bottom of the cycle, and the next move probably up. But I don't think the next move up is going to take place anytime soon. I'm not expecting it this year.
No, and you talked about caution when you started talking, but you have revised your forecast from 2% to 4.2% for the year, and you were saying it's a slight upward revision, but 4.2 is quite significant if you're looking at the base that you were looking at 2%. What is behind that confidence?
What is behind that is as I've said, I expect a slower economic growth rate this year than last year. But against that, I am getting the feeling now that the lending, the banks as a group may ease up on their mortgage lending. Certainly, they've eased up a lot more at an earlier stage in their short-term lending, their unsecured lending, and I think mortgage lending may undergo some easing up. And I think the borrower as well on the other side, I think as time goes by, will get a bit more comfortable. It's as I say, it's often the wrong thing to do because people tend to be at their most confident when it comes to lending or borrowing just before interest rates go up, and that's not the right time. But that is the way these cycles tend to work. We're in what looks to be like an almost abnormally long period of cutting to sideways movement in interest rates. We've already had over a year of interest rates unchanged at what appears to be near the bottom of the cycle. This is quite a lengthy period, and you would expect gradually as time goes by people start perceiving risk to have declined. And that's what drives me to believe that we might just have slightly higher average growth now this year than last year, but 4% as opposed to 3% last year. It's not meaningful. It's still real house price decline, so it's not shooting the lights out.
When I speak to estate agents, one of the things that they'll say, for instance, is that the Credit Act really, really brilliant. It helps not only individuals but the economy overall because of what it implies and what it means in the long run. But we're saying that sometimes when it comes to evaluating buyers that would come into the market, for the most part, it's done through a computer, and so people that could qualify are then thrown out and don't qualify. And the estate agents that I've spoken to was perhaps looking at doing business differently, where banks are looking at individuals, as individuals and not just putting numbers and crunching numbers through a computer system. When it comes to going forward, and you were talking about competition increasing in this space as we're going forward, as the economy is recovering, how should banks be looking at how they're doing business, and what should the approach be?
Well, I think the criticism that we might be too model and system driven there is some merit to that. Systems and models do, however, bring objectivity to it. In older days, what you often happened was, I play golf with you, therefore you get the loan. Very simplistically put. So there is an objectivity and a discipline brought about often by systems and models, but you can take it too far, and there has to be some judgmental side to it, because admittedly models and systems will never be perfect. But so it's a bit of a balancing act, and it's always difficult to get it right. I'm not convinced that a lot of clients that shouldn't or that should qualify are thrown out. I think that is often exaggerated, but also what I perceive a problem to be is the clients aren't always necessarily thrown out. They will qualify for a smaller size of loan, but the interpretation seems to be, if I'm rejected for that particular size of loan, I can't get credit, and I think that's a mistake. It might be that you have to moderate your aspirations and buy somewhat down. But I think sometimes clients should look and say, well, if the bank has rejected my application, maybe I should just look at my finances more closely, see it as a positive signal. Because the idea now is to lend to people in such a way that they don't get into financial trouble. So it should possibly be seen in a more positive light, and people should perhaps reconsider it, and maybe they are just a bit too close to the edge. Maybe they aren't making provision for the certainty of interest rate hiking at some point. Will they be able to absorb that? Will they be able to absorb very sharp rates and tariff increase hikes that are coming? There's a lot of cost fluctuations, and you need buffers. and perhaps its rejection of a loan application should be seen in a different light.
Let's talk a little bit about risk. Where do you think banks are now? Because, I mean, they have been quite risk averse, and rightly so, considering what's been happening around the world. With their approach with business right now, and you would, and again, I allude to that issue of competition. How do you think banks are going to approach this risk factor going forward, particularly in this segment of the market?
I think the reality, if one looks at the previous cycle, and if one looks at sort of typical behaviour, even abroad with lenders / borrowers, it's always difficult to know exactly who. It takes two, but as periods of low interest rates move on, they tend to get more confident. Personally, I think that it's what I think the previous governor of the Reserve Bank alluded to as pro-cyclical behaviour, if I remember. And I'm not always sure it's correct, but it is the way I think it will pan out again. Personally, I think I would like to see behaviour being more counter-cyclical, because I think the lowest risk periods in an interest rate cycle are when interest rates are about to and then start coming down. I think that is the lowest risk period, not as you're getting closer and closer to the next interest rate hiking cycle. But be that as it may, we tend to see credit growth tick up closer and closer you get to the next interest rate hiking cycle, I think. And that's so what I believe and what's reality, I think, are two different things.